Diane is a 58-year-old retired administrative assistant in Brampton. She has lived with severe rheumatoid arthritis for over a decade. Getting dressed takes 45 minutes most mornings. Some mornings it doesn't happen at all. 3 years ago, her doctor completed the T2201 disability certificate and sent it to the Canada Revenue Agency. 6 weeks later, Diane got a letter. Denied. She put it in a drawer and assumed that was the end of it. It wasn't. Here is what most Canadians don't know about the disability tax credit. For 2024, the federal credit alone reduces tax owing by roughly $1,700 per year. Add provincial credits, and the combined annual saving is between $2,500 and $4,000. Now multiply by 10 years. CRA allows adjustments going back a full decade. Diane has been eligible since at least 2015. If her appeal succeeds, she is looking at a retroactive claim between $25,000 and $40,000. And starting in 2025, the Canada Disability Benefit, a new monthly payment, requires an approved T2201 as the gateway. Diane isn't just leaving past savings behind, she is locked out of future payments too. Here is the part that changes everything. The problem with most DTC denials is almost never the person, it is the form. The T2201 requires the medical practitioner to certify that the impairment affects basic daily activities, dressing, feeding, walking, all or substantially all of the time. CRA interprets that as roughly 90% of the time. Diane's doctor described her condition accurately, but he used the word frequently instead of all or substantially all of the time. That single word gave CRA the reason to deny. The medical reality hadn't changed. The words on the form had failed her. There is a second pathway that is even more commonly missed. The T2201 has a cumulative effect section. If a person has multiple impairments, none severe enough to qualify individually, their combined effect on daily living can still meet the threshold. This section is left blank on a staggering number of applications, simply because the medical practitioner didn't know it existed. After a denial, you have two distinct options. The first is a request for reconsideration. This is not a formal legal process. You write to the CRA office that issued the denial, include updated documentation with precise language, and ask them to take another look. No special form required. The key is acting within 90 days of the denial letter. If reconsideration fails, or if a notice of assessment has been issued, the second path is a formal notice of objection. You have 90 days from the date of that notice of assessment to file. Miss that window, and you would need to apply to the Tax Court of Canada. Diane was within the window. Barely. Here is your checklist. 1. Log into CRA My Account and find the original denial or notice of assessment. Write down the exact date. Count 90 days forward. That is your deadline. 2. Go back to the medical practitioner who completed the T2201. Ask whether the cumulative effect section was considered. Ask whether the language meets the all or substantially all of the time standard. A revised submission with precise wording can change the outcome entirely. 3. If you are past the reconsideration window but within 90 days of the notice of assessment, file the objection now. You can add medical evidence later. Filing on time preserves your rights. Filing late may extinguish them permanently. A denial from CRA is not a medical verdict. It is a paperwork problem, and Diane's case shows that paperwork problems have solutions, but only if you act before the clock runs out.